Think about the last time you needed information. Did you Google it or did you ask ChatGPT or Gemini? That simple shift is why investors are now asking, is AI going to replace search entirely? Alphabet just dropped their Q1 2026 earnings a few days ago, and it triggered a massive 10% gap up that added a staggering 421 billion to its market cap in a single day. To put that into perspective, Google essentially added the entire value of Netflix to its balance sheet in just 24 hours. I believe the big question every investor has in their mind is Alphabet still burning cash on AI, or have they finally cracked the AI flywheel? The answer is becoming clear to me. Whether Alphabet is already in your portfolio or you are thinking of buying the stock, you will want to pay close attention to this video. I will also be talking about a move they have made recently that isn't getting much attention later in the video. This diagram that you are seeing on the screen now shows a growth cycle for hyperscaler like Alphabet, Microsoft, and Amazon. It follows this simple pipeline that begins with massive AI investment. This capital is deployed to build out global infrastructure, including their own AI model, specialized AI chips, data center, and power grid. Once the infrastructure is ready, these capabilities are packaged as cloud services to attract high-value enterprise orders. Finally, as these order contracts are fulfilled, revenues and profit are locked in, and the high CAPEX investment will be paid off. So, question is, where is Alphabet in this growth cycle? Let's find out. Before we discuss whether their search business has been jeopardized by AI, let's go through their top line numbers. Alphabet has brought in almost 110 billion in revenue this quarter. That is a 22% jump year over year. And this is really impressive because this is already their 11th consecutive quarter of double-digit growth. Next, their net income. It increased by 81% to 62.6 billion. That jump is huge, but I do want to point out something very important here. Out of the 62.6 billion, about 37.7 billion of that came from other income. In this case, it is their equity investment, things like SpaceX and Anthropic. These are mark-to-market gains. They are unrealized profit from those investments. So, for a more conservative and accurate measure of financial health, we can look at their operating income, which grew 30% to nearly 40 billion. It is also very impressive. And for the operating margin, it expanded from 34% to 36.1%. This increase in operating margin revealed something important. To see margin expand while spending that kind of massive capex tells me they're able to find ways to improve efficiency in their businesses. For their earnings per share, it came in at $5.11 versus analyst expectation of $2.63. That is a 95% surprise. And year over year, there is a 82% increase from $2.81. Overall, I think it is an amazing set of numbers, and these are the kind of numbers most companies can only aspire to achieve. We will talk more about their Google Cloud business, but let's address the bear thesis first. Is their search business still alive? Investors have been worried for 2 years that AI chatbots could cannibalize Google's search business. People who stop Googling things and just ask ChatGPT instead. Here is what the data actually shows. Google search revenue grew 19% to 60.4 billion this quarter, and the search query volumes hit all-time high. The number is clear. AI is not killing search. In fact, the search volume is expanding. AI looks more like a tailwind rather than a threat. Currently, how do people perform their search? They enter a query, and a bunch of links appear for the user to click on it, and the user can go and read the information on those websites to get what they need. On the earnings call, the management shared that after they roll out the AI mode in the search page, users don't search lesser, they actually started to search more, and the search become more complex. Users are asking follow-up questions, they're diving deeper into the query. Google is seeing there's a higher quality in user engagement. And here is what I found incredible. Google has cut the cost of delivering AI search responses by more than 30% thanks to their own Gemini 3 model and custom TPU chips. This matters a lot as a business. It means they can scale this AI search experience without blowing up their margins. This directly addresses a concern that Google is moving from a high margin business to a low margin business that required high CAPEX investment. I think they have made a right decision to focus on hardware engineering optimization. This can ensure their long-term profitability. Next, before we go into their new strategic move, let's discuss another key area first, Google Cloud. If search is the cash cow, you can see Google Cloud as the rocket ship. To me, this is the most transformative highlight of this quarter earnings. Google Cloud crosses 20 billion in revenue for the first time this quarter. That is a growth of 63% year over year. For context, this is outpacing their major competitors. Will this impressive growth continue? I think so. Take a look at their backlog figure. It is 462 billion. There is a long queue of contracted future revenue from enterprise customer, and it nearly doubled quarter over quarter. And also, this figure is larger than the GDP of many countries. Gemini Enterprise paid monthly active user also grew 40% in a single quarter. This figure sends a very clear signal. Businesses are not just experimenting with Google AI tool anymore. If they're not getting real value, I'm sure no company could pay for them. There is another AI adoption metric. First-party model like Gemini now process over 16 billion tokens per minute via direct API usage. That is a 60% increase from the previous quarter. Here is how I see Alphabet. It is no longer a search company. With that 462 billion backlog, they're now becoming a company providing the infrastructure layer of the global AI economy. Now let's talk about a strategic move that Google has just made, which is not getting much attention yet. After which we will address the final elephant in the room. Google is undergoing a subtle yet profound shift. Currently, Google only allows customers to rent TPU capacity through their own cloud. For the first time, Google is selling his custom AI chip to outside customers for use in their own data center. This move represents a major change from their previous business direction. Google has signed a multi-billion-dollar deal with Meta to provide TPU access. Reportedly, there is also talks of selling the Tensor chips directly to Meta. Google also signed a massive deal with Anthropic to use up to 1 million of their chips. Anthropic CEO has explained the reason why he has chosen to use Google TPU. It is because of the chip strong price to performance and also the chip efficiency. Why does this matter? Because today, the AI industry runs almost entirely on NVIDIA hardware, and Alphabet is trying to change that. This move can expand Google's footprint in the AI hardware and provide a competitive alternative to NVIDIA dominance in the GPU space. By getting enterprise customers to build on Google proprietary silicon, Google is increasing their moat by creating high switching costs for the customer. Once companies build their infrastructure on Google TPU chips, walking away becomes much harder. Revenue from this is still small today, but the strategic intent is clear. Alphabet wants to become the hardware and software foundation that the AI economy is built on. That is a very different and potentially much larger business than selling search advertisement. Another thing worth highlighting is their paid subscription like YouTube Premium and Google One. They have now hit 350 million paid subscriptions. YouTube subscriptions are now growing faster than advertising revenue, with YouTube Premium and Music reaching their largest quarterly increase in non-trial subscribers since 2018. They have successfully pivoted from a pure advertising business into the high retention subscription business. For a value investor, this is a gold mine because subscription revenue is recurring. It creates predictable cash flow. And also, just for context, YouTube revenue has now surpassed Netflix revenue. Google has revealed YouTube brought in more than 60 billion in revenue in 2025 versus Netflix revenue of only 45 billion. Before we address the final elephant in the room, let's quickly talk about their other bet, Waymo. For those who are not familiar, Waymo is Google autonomous driving technology. They have announced they have just crossed 500,000 fully autonomous rides per week across 11 US cities. That figure has doubled in less than a year. With that kind of traction, Waymo is no longer an R&D project. It is time for a real viable commercial offering, which I believe it will bring in meaningful revenue in near future. Alright, let's talk about the final elephant in the room, CAPEX. It was 35.7 billion this quarter alone. That is a huge 107% year-over-year growth. During the earnings call, Alphabet has also provided guidance on their full year 2026 spending to be around 180 to 190 billion. The management also warned that next year, 2027, will be significantly higher than this year. That is a staggering amount of money that will eat into their free cash flow in a big way. The quarterly free cash flow has dropped to around 10 billion, and the trailing 12-month free cash flow is on a downward trend. This indicates that the current rate of infrastructure investment is outpacing the rate at which the company is growing its operating cash flow. As an investor, should we be concerned? The concern can be addressed by the 462 billion backlog. The backlog provides a clear revenue visibility that justifies the current aggressive infrastructure build-out. The CEO has also provided his response to this concern. He has mentioned that every capital allocation decision is made through a robust return on invested capital framework. If you ask me my take, I see this as a calculated bet. The spending has risk, but it is not reckless. It all boils down to how well they can execute the plan, and so far the management team has been doing a great job. The CEO has also emphasized a move towards agentic workflow, where AI agents perform complex tasks for user. AI is no longer just providing information. For example, for a user who is looking for a restaurant, previously the user will search for where is a good restaurant. But now with agentic AI, the agent will find the restaurant based on the user preference, and the agent can also help the user to do the booking, and it can also send invites to their guests. When more and more people is using AI agent to perform the task for them, the dependency on AI will only continue to grow exponentially. The future of AI is becoming even more exciting. So, has Google finally cracked the AI flywheel? I think they have. Remember this growth cycle diagram? The flywheel is in full motion. The initial investment has translated into revenue and profit. Alphabet has successfully navigated the most dangerous phase of the AI transition. They have turned AI from an existential threat to their core search business into a real growth driver. The search business is getting stronger, the cloud business is accelerating, and the backlog is at a record level. And they are quietly building a hardware business and a driverless technology that could be transformational in 2027 and beyond. That's all for this video. If you found this useful, subscribe for more and hit the like button so that more people can find this content. Do drop in the comment below on what is your take on the latest earnings result. I'd love to hear from you. I will see you in the next video.